Welcome to the weekend edition of the Fear and Greed Business Headlines, the week that was, a wrap of the biggest stories over the past week. I'm Sean Aylmer. It was a big week of COVID, a very big week of corporate deals, fickle financial markets, and of course, plenty of economics. Let's start with financial markets. It was very up and down, which I suppose is what markets do. Having reached new records a week ago, Wall Street fell back as the rate of COVID cases escalated around the world. All that confidence about interest rates rising in the next couple of years seems to have dissipated. Well, not totally, but just a little. 10-year US bond yields, which reflect interest rate expectations, have fallen back below 1.3%. The local share market didn't do a great amount. It was a better week for technology stocks and consumer staples, reflecting the COVID news, and energy companies and utility stocks underperformed. Investors are caught between the great economic news, which just keeps rolling out, and the rising number of COVID cases. Oil prices started the week strongly. The world's largest oil producers couldn't agree on lifting production in coming months, which is a time of strong demand because of the Northern Hemisphere summer. That pushed prices to their highest level in 3 years. Didn't we notice that at the petrol pump? But later in the week, oil prices fell back sharply. Gold crept up all week, reflecting its role as a store of value. In tough times, people like gold. And the Aussie dollar depreciated during the week against the US dollar. The greenback is back in favour, reflecting greater economic uncertainty. In global news, the COVID data this week wasn't encouraging. The downward trend has stalled, and in some countries, reversed, as the Delta and Beta variants of the virus spread rapidly, particularly in non-vaccinated regions. There's been a surge in cases in countries with low vaccination rates, including South Korea, Indonesia, South Africa, Russia, Colombia, and Mexico. Even in places with high vaccination rates, notably the United Kingdom, a bunch of states in the US, parts of Europe, and Israel, case numbers are rising. Tokyo this week declared a state of emergency and banned spectators from the Olympics, which are 2 weeks away, after its worst day of new cases since May. This week, the Haitian president was assassinated in his home following unrest in the impoverished Caribbean nation in recent months. The country is facing a humanitarian crisis and a widespread shortage of food. Cyber hackers hit more than 1,000 companies around the world after attacking an information technology management software supplier, throwing supply chains into chaos. It was yet another case of cybercrime extensively disrupting business. This week, Chinese regulators ordered app stores to remove ride-sharing group Didi just days after the company completed one of the largest IPOs ever on Wall Street. By the end of the week, Beijing had introduced more restrictions on listings outside China, and the investor appetite for Chinese stocks on Wall Street plummeted. And Jeff Bezos ended his reign as boss of Amazon this week. And this weekend, the 57-year-old is literally heading into space on his self-funded rocket ship. You can do that when you're worth more than $200 billion US. On to local news. COVID was the dominant news event of the week, at least in New South Wales. While other parts of the country have gotten their community-transmitted cases down to zero, the numbers in New South Wales are rising, as are hospitalisation and intensive care rates. As it stands today, the spread of the Delta strand of the coronavirus is getting worse, not better. The Sydney lockdown has been tightened and could well go beyond its scheduled end next Friday. Canberra has promised more vaccines and some financial assistance. State Premier Gladys Berejiklian acknowledged the health and economic distress the virus is causing. It's a very tough time for Sydney-siders at the moment. There was plenty to digest on the economic front this week. The Reserve Bank of Australia said it still intended to keep the official cash rate unchanged until 2024, but it dropped the phrase 2024 at the earliest. In Reserve Bank speak, that's significant. Governor Philip Lowe said while the current restrictions meant there was some near-term uncertainty, the economy was likely to bounce back quickly once they all ended. Let's hope that's soon. The labour market was better than expected, including a welcome fall in underemployment. Notwithstanding those facts, the pickup in inflation and wages growth will be gradual and modest, Dr. Lowe said. In other economic news, the number of job advertisements rose for the 13th consecutive month during June, and are consistent with an unemployment rate of around 5%, according to ANZ. Labour force figures for June are out next week, but there's little doubt about the cracking jobs market. Retail sales in Australia rose 0.4% during June, and was 7.7% higher than a year ago after being upwardly revised by the Australian Bureau of Statistics. But the number of dwelling approvals fell 7% in May, following a near 6% drop in April. The numbers come off record highs thanks to the home builder subsidy, which ended in March, so no one was particularly concerned. There are a couple of very interesting green investments this week. Andrew Forrest put $50 million into a Bill Gates-led venture capital fund, which focuses on emerging greenhouse gas reducing technologies. His mates in the fund include Amazon's Jeff Bezos, Virgin founder Richard Branson, former New York City Mayor Michael Bloomberg, and Saudi Arabia's Prince Al-Walid bin Talal. And James Murdoch, the son of Rupert, has committed money to a $250 million climate finance fund, which targets emerging markets. The fund, run by BlackRock, will invest in green energy infrastructure. Doesn't sound very Murdoch-esque to me. In corporate news, the Victorian Royal Commission into Crown went on and on. Shareholders now have a genuine reason to be concerned about their gaming group losing its licence in Victoria, and Crown's share price continued to stumble. Underpayment of tax, not managing problem gamblers, and question marks over whether the group had changed enough were just some of the allegations and issues this week. But perhaps the worst came on Thursday, when Chair Helen Coonan conceded the board had sent a letter to the Victorian government just last week saying it was not in the public interest for Crown to fail. Commissioner Finkelstein was not impressed and said the letter amounted to Crown warning the government to make sure he, Commissioner Finkelstein, didn't make a specific finding, presumably that Crown should lose its licence in Melbourne. It was a good week for Seven Group, which managed to acquire more than 40% of Boral without paying a significant premium for the building materials group. The saga, and it's been a saga, has been going on for a while, and the board of Boral had rejected the takeover offer. But in the end, Seven gained effective control of Boral, having only paid a share price about 10% higher than when the original bid was made. Tabcorp decided to demerge its lotteries and keno business, rejecting takeover offers for its wagering and gaming enterprises. Chair Stephen Gregg said an internal review had found a demerger was the best option, saying there wasn't enough certainty around the different bids for parts of the business. The decision to hive off the lotteries and keno business comes after plenty of pressure from large shareholders. Shares in the embattled retailer Myer surged after billionaire Solomon Lew launched a fresh attack on the company's board. Mr. Lew, the chairman of Premier Investments, confirmed he spent more than $16 million to increase his stake in Myer to at least 15.8%. He then went on to call on 3 of the department store's long-term directors to step down. Mr. Lew has been a long-time critic of the Myer board, and nothing seems to have changed. There are a bunch of other smaller deals this week. Westpac sold its New Zealand life insurance business to Fidelity Life for $373 million. Ramsay Health increased its offer for Spire Healthcare in the United Kingdom, valuing the group at $2 billion. And US-based private equity group Apollo Global and Bermuda-based life assurance group Athene joined together to take an 18% stake in annuity provider and fund manager Challenger Limited. Zipco's share price jumped 14% on Thursday on speculation that a strategic investor had bought into the buy now pay later group. Swiss competitor Klarna was most likely, analysts said. Now I get to the point of the program where I go through the biggest story of the week, the sleeper story, the most remarkable story, and my favourite story. The biggest story of the week was corporate takeovers and mergers and acquisitions activity. The world's not quite going crazy, but fund managers, including the big superannuation groups, are getting closer. I've already mentioned a fair bit of corporate activity, but the really big one this week was for Sydney Airport. A bunch of infrastructure investors, including IFM, which represents 26 superannuation funds, and Australian Super, have made the biggest takeover offer in Australian corporate history. They want to pay $22 billion for the gateway to the country, wanting to own the steady income stream that comes with infrastructure assets. The price was a 40% premium to Sydney Airport's current trading price, though it was still below its pre-pandemic peak. The bid demonstrates the might of the super funds in Australia. They receive 10% of people's pay each month and have plenty of money to spend. Let's hope all this enthusiasm for assets doesn't mean they're spending too much when buying up assets. The sleeper story of the week came from Europe. The continent, particularly France and Germany, are edging towards more normal relations with China. The three nations this week committed to resurrecting an investment treaty after their leaders met. Following that, China's President Xi Jinping called for stronger cooperation between Europe and Beijing in trade and culture, climate change, and defeating the coronavirus. It's easy to see China as the bogeyman in the region, probably because it is, but other economies are developing strategic alliances with the world's second largest economy. That's very, very significant, and that's why it's the sleeper story of the week for me. The most remarkable story this week came from the OECD. It estimated that 22 million fewer people are in the workforce in advanced economies as a result of COVID-19. We think about the booming jobs market here in Australia, and there's 1% more jobs now than back in February 2020. But we're the outlier. There are millions of fewer jobs around the world thanks to COVID. I know it shouldn't be remarkable. Maybe it's the surprise story of the week. And my favourite story of the week came from the New York Times and was all about golf. The sport might be royal and ancient, but it's been full of crusty white males for too long, and its popularity has diminished. 1,600 courses across the United States have closed over the past 10 years. But during the last 3 years, it's become hip again. A bunch of 6 and 12-hole courses have opened. The average age of players has dropped dramatically, with many more female participants. There are sports bars at driving ranges, loud music on courses, and the etiquette of the sport has been relaxed. I can start wearing silly clothes again. That's why it's my favourite story. And that's everything you need to know from the last week. I'm Aylmer. I'll be back on Monday morning with a Fear and Greed business headlines. I look forward to your company then.